If you're looking for a company that can improve the quality of your stock portfolio, I think I might have just the company for you today. I know it's a struggle reviewing our portfolios. We're all in the same boat. We're always looking for that extra company, and I found one. Potentially go to the top of your buy list 2023. I estimate the return, spoiler alert, but the full details later, to be over 10% a year from this. And it's a high quality company. So I've added this company to my portfolio and I've sold out another company. So I've improved the quality of my portfolio. So let's see, is this company going to be a good company for you? Or is it going to be another boohoo? Let's crack on the video, find out. So let's start. I'm going to added to my portfolio very first time, Williams Sonoma. They recognise them all with brand names like Pottery Barn. What attracted me to this company, first of all, was the quality of some of the numbers. Return on capital really caught my eye. Been very high consistently, 10 years, and it's currently 48%. 48%, an incredible number. Gross margins are good. I prefer slightly higher, 42.4%. Always above 35%. Decent gross margin. Jumping over to the income statement, the operating margin is all positive and has recently been increasing. See that figure now, 17.5. Company is founded in the 1950s. It's got a good track record, and I would say they are very unlikely to fail. We illustrate that by looking at the current ratio, always above 1, and the debt to equity always below 100%, and they're very much able to pay back debt. The interest cover, very high. Take a look at Simply Wall Street. We see that debt level more easily. Very impressive there. And a very nice balance sheet. Very unlikely to fail. Now, the dividend is an important factor. And the dividend is also attractive. It's 3%. I wouldn't buy this as a pure dividend play. Payout ratio is pretty low. And we look at the light blue line here. Dividend per share consistently been growing. 2013, under $1 a share. Now looking at well over $3 a share, projected to increase further. And that payout is very affordable. And in fact, if we head back to the income statement, it's always been a good payout ratio, although it has improved a bit in recent years. Good increases we can see, dividend per share, and actually share buybacks every year for many years. See that's been dropping consistently. Weighted average shares outstanding has gone down, well, around about 30% in the last 10 years. Driving 3% a year to the shareholder. Buybacks as well, adding a little bit more of that. So you're probably getting 6% without any capital appreciation. Starting to look very attractive. Now, if we can find the company growing, that'll be interesting because that can add even more to our return. Yahoo Finance is saying almost 9% a year. And there's a bit of growth here going on Simply Wall Street as well. I think they could do 6%. That's the estimate I've used in my calculation. Let's take us to the valuation. Those that are interested, their PE is single digits. But I'm more interested in free cash flow yield and also a discounted cash flow. Those are the two ways that I've attempted to assign a value and then projected rate of return for this company. So the free cash flow yield is actually 9.22% when I calculated it a few days ago. The market price was marginally lower than it is today. It was at market price of 15. Very high free cash flow yield. And then the discounted cash flows give me following results. Potential range of returns, 12.7% a year, 15.2% a year. And I want 10% plus per year in my portfolio, with that range being 12.7 to 15.2. There is a bit of a margin of safety, so I can either overachieve, or if I got my numbers a bit wrong, I can still make that 10% plus. Adding them to my portfolio, and here is the information on ShareSite. My average purchase price is $114, and I added about £650. I'm not averse to adding a similar amount should the price drop further in the future. That brings me on to the sale, because I do not want to increase the number of positions in my portfolio. In fact, I want to reduce the number over time to 20, maximum 25 stocks. Above that today. So I've sold in order to make sure I'm not increasing the number. Argo blockchain, you can see the performance here. My last portfolio update, very poor, pointless value really in the portfolio. So that was an easy one. Switch out for a company that is clearly higher quality company that can be held for the long term. Now I'd be really interested here if you hold Argo or indeed WSM. If you drop me a comment below, tell me about your holding. I'll do my best to respond. Guys, hold up. Before you go, check out this video here. In fact, over here, it's going to appear over my Lego, my Star Wars Lego. This video is a UK company that's just released massive dividend news. It's in my portfolio. Check it out. It could be a good investment for you. This video here. See you there.